Best ever listeners, welcome to the best ever CRE show. This is Beyond Multifamily. I'm Amanda Cruz, joined with Ash Patel, where we break down every Wednesday everything that is not multifamily. Sometimes we might also give multifamily users a bad rap. So if that's going to hurt your feelings, don't listen. But if you want something outside of multifamily, every Wednesday we're here. Ash, what's up?
Hey, Amanda, today's interview was pretty freaking cool. This guy, Ian Noble, he started out in the business world and then moved on to be a capital raiser. You know, two of my biggest pet peeves are all the nonsense about buying businesses. And you know how I feel about capital raisers. We called out everybody and everything today. This was a really cool episode.
Hell yeah. Ian was awesome. He started with such humble, hardworking beginnings. So I think that's going to really resonate with a lot of the best ever listeners. He definitely didn't get anything handed to him besides kind of a really tough business that he had to make work. So that was good. He does fund of funds for mobile home parks. And after we recorded, we talked a ton about doing funds of funds. And he actually looked at me and asked if I'm a fund of funds manager. It's like, Ian, did you not get anything out of this conversation today?
Yeah,
No, I'm not a fund of funds manager.
I feel like you screwed up somewhere, Amanda. And you know what, best ever listeners, listen to the podcast and find out exactly where Amanda went wrong and let her know.
I can't wait to hear all the ways that I should improve. Also, we'd love to interview a lot of listeners. If you're into assets that are not multifamily, you can go to bestevercre.com and you can apply there. We'd love to have you on the show.
Let's go.
Ian Noble, welcome to the best ever CRE show. How's it going?
It's going great. Thanks for having me, Amanda. Ash, appreciate being on y'all's show.
Hey, we're looking forward to chatting with you today. You have an interesting history, and I know the best ever listeners are going to resonate with your story. Can you start by sharing your background and what you focus on now?
Yes. So my background is as a small business owner. I grew up into a family business. My father had a dry cleaners. And so growing up as a kid, I would sleep at that place, like in the old laundry carts. And over the years, I ended up, the plan wasn't to get involved with it. And after going to school at UT in Austin, the business was in a tough spot. And I got into it and worked it, learned from the ground up, started pressing clothing in the Texas heat. It was brutal. So a lot of respect for that team, and learned my stripes that way in business. And then my transition to real estate, just along the way, as I ran that business, I started buying rental properties, single family to start, then, duplex here and there, some small commercial properties. And then it just led into that. So my transition from where I was as an active investor to now, where I do both active and passive investing, all comes from my run at my 14 years in small business.
Ian, dry cleaning is like one of the hottest businesses right now, right? Why didn't you just take that and keep buying more dry cleaners? Why'd you exit out of that?
Yeah, I get this question asked a lot. I'm young, and people like dry cleaners. They like laundromats, and it's this whole push for like boring businesses. My issue was that when I first started, I was 21 and I didn't have any mentors. My dad no longer worked with the company. He kind of removed himself from it. So everything was self-taught to a degree. And as a result of that, I had the work ethic, but my business acumen wasn't quite there yet. And I put myself in the middle of every process. And this ended up burning me out, right? Like so many business owners talk about this. There's an emotional toll that comes with running your own business. And over the years, kind of the writing on the wall was that when your heart's not in it anymore, or the biggest struggle of all, like when you come home and you look at your kids and your wife and like you're physically present, but you are not there. That was my situation. I had about 95 employees. We ran it really lean. There were about 3 of us running the whole show. And so I was very much an owner operator and trapped. So had I had, the EOS model or traction or read these books back in the day, I think it would have benefited me a lot, but it was time for me to go and to hand it to the next person that was, full of fire and ready to go in that industry.
Ian, how many years were you involved in the dry cleaner?
About 14.
Okay. You put a lot of time in. That's a lot of burnout, huh?
It was, yeah. Long days too. I wish I would have done that differently also, but I thought that, working longer and, it was a dark to dark job. I'd go to, 6 a.m, come home at 6:30 or so, but never turned it off.
I'm sure you've learned a lot of lessons there that apply to real estate now. But before we dive into what you're doing now, I want to reiterate your points. You've seen on social media the hottest thing is buying boring businesses, right? And really just buying any business. I think that post COVID, where people got to work from home, now everyone's getting called back to the office. Employee satisfaction is the lowest it's been forever, which is why this message of, hey, go buy a business, you don't need your W-2, is resonating with so many people. Can you talk about the challenges, the pitfalls? Like you said, you never saw your family. All the things that people don't talk about on these social media posts. It's such bullshit what they're spewing out there. People are buying into this notion, oh, you know what? I'm just going to buy a laundromat. I'm going to buy a car wash. The challenges. Talk about some of those if you don't mind.
Yeah, I'm glad you brought this up. So yes, buying boring businesses are good. So you often think, okay, what can I do that won't be necessarily replaced by tech? Or what is something to where I, as an owner, will have job security? But the reality of that is there's so many people, like a lot of MBA grads will come out now and they'll go through these search funds and say, I'm ready to buy this business. And there are good opportunities out there, but what you can't teach sometimes is work ethic. You have to fit the mold of this entrepreneur, because if you're coming from a W-2 job, it's a whole nother world. The success of the business rides on your shoulders. And too often, people think, okay, I don't necessarily think they take that for granted, but there's an immense amount of pressure. And so social media is, strange like that, because of course, I own 7 businesses and make millions a month and all that crap. Now, you can make a ton of money in running a business from a cash flow perspective, especially like in the, real estate gets rocky sometimes. I know you guys are real estate focused. I think from a cash flow perspective, there could be no better way to keep yourself going than running a successful business. But people underestimate how much time it takes, and now I do envy those that can run it and run it well with, managing their teams, making sure the right people are in place. For those that do it successfully, yeah, they're in an amazing spot.
But how many years did it take for them to get there? They had the years of grinding, the weight of the world on their shoulders.
Too many. And I'll tell you, you run into these things like COVID, for example. Some businesses did amazing. Mine did not, right? I lost 80% of revenue, 85%, like within a few weeks. So
why?
What do? You've got
no one needs their shit dry cleaned.
Nobody was going.
Oh, it's all businesses. As business.
People were on Zoom calls.
Yeah,
in the road.
that makes sense.
Yeah, Austin was always a pretty casual place to begin with, but people stopped going to the office, and so here we are. Business challenges. We didn't have any business, but I'd never worked harder in my life. Right? Here comes the weight on your shoulders. Like, how am I going to survive this? I had to fire 25, 30 people. We had to cut stores. We had to reorganize the whole way we ran things. I was scrambling for the first time in my life. I was looking for government money, right? Like, I was that guy that's like, I'm not taking government handouts. And then, that really helped a lot of businesses get through. And so COVID was a really special time, because it was like we had no clothing coming in the door, but I've never worked harder in my life because there is not an option to fail. If you fail, it's what's left at the end of the day. And I have too many families at that point that were depending on me and myself and my pride and ego, for that matter. Like, I'm not going to let this thing fail.
Would you ever get into a business again?
Yes. Yeah. I love small business, and I think that there's always opportunities to learn from what you've done. So what I would do differently this time is I'd buy an established business, and I think this will happen, right? I think this goes hand in hand with my passion in real estate. But buy the business, buy the real estate. But I want to get into something that has a team that's already running to where they're at the core of it, because that was my issue. Just from not knowing any better, I thought that the business needed me so much. And it wasn't until those last couple of years where we had 2 incredible people still there with the new owner, by the way. He's doing amazing. They're running the show. They run the stores. They run the cleaning facilities. And so I think doing it again, I'll make sure to focus on putting their talents first and not making it about me, because selfishly, number one, I had to do it. The business had the roots set up, but it was broke. There was nothing left over. So it took many years to put in systems in place, boost profits, make this a highly profitable company, just through a lot of sweat and failure too along the way.
Ian, you learned a ton, and yes, you were burned out. But why pivot to real estate, which you said typically doesn't have as much cash flow as businesses, when it sounds like what you needed the most was cash flow? Why the pivot?
What helped me along the way was that I started to make money outside of my business very early on. So in 2014, I bought my first rental property, single family home. This was me listening to Bigger Pockets as a 20-year-old or early 20s. So I started doing that. And each year my goal was to buy a property. And back in the day, in Austin, these rental properties were $100,000, $200,000. And so my goal was, look, I already have the cash flow for my business. Let's start making money outside of it, with the eventual hope that I could make as much as I did through my small business. I could make as much in real estate. And maybe some point those two intersect and I call it quits. I never quite got there because the business was doing amazing, but the transition made it really evident. I loved real estate already. I knew from a wealth building perspective, if I had cash flow already, then all of a sudden I put in my time and effort to these properties years ago, and I worked really hard and aggressively paid down debt, maybe too much, right? Like my only goal was to get rid of all debt on those properties. And so that's what I did. And then COVID hit, and then we had this wild wave of appreciation. And I thought, well, this is cool. Now, just a number on a piece of paper, right? Things have kind of, settled themselves since. But the path was very easy. And the natural transition into my business today is that when I sold my business, I just finished. So I was 7 figures in debt with the business to begin with, right? So I bought it for my family. The IRS doesn't like handouts, and my dad deserved to be paid well for what he built. I had just finished paying that off, and then I sold the company. And at that point, it's like, I'm going to have a big tax bill coming up. What can I do? Because like everybody else trying to figure out, it's not what you make, it's what you keep. And so this was one of those, I dove pretty heavily into the passive real estate investing world because I knew I was only limited with the properties that I had. I was looking at, okay, can I do a cost segregation study on all my properties? What can I invest in to help me, build wealth while at the same time not having to pay taxes? Again, we are, my wife's a real estate professional. At the time, she was the one. Now we both are. So we had a lot of options at our disposal. But that really is what kind of led me into this world of, wow, I need to tell other business owners about this because maybe cash flow is not the issue. It's what happens when you sell or you're going to retire or you get a disability and the business depends on you. All of these things that I wish somebody came to me 10 years ago and said, hey, do you want to get in on this? Because you're pretty busy already, I think. So, but you have you have the means to invest with us or to partner. I would have done it all day long, but I didn't know it existed. I honestly thought I just had to buy property. Like I just got to do it myself. I had no idea about this whole private equity, partnership world that was out there at the time.
One of the keys that you mentioned was you were passionate about real estate. You loved it. This is what a lot of people miss when they're buying businesses. I'm sure at some point your dad was passionate about what he was doing with the business, right? When people buy second gen businesses, they're doing it as a transaction and as a way to make money. Whereas the founder or the previous owner may have done it because they were passionate about it. And it often doesn't work when you treat a business like a transaction. You've got to love what you're doing.
Ash, why is that? Why do you think you can't use it as a transaction like we do with real estate?
Okay, let me rephrase that. You can use it as a transaction, but it's not going to be anywhere near as successful as if you truly are passionate about it and you love doing it. There's a big difference there.
Fair enough. What you're saying, yeah. I mean, statistically, second generation business owners are it's a failing stat, right? Never as good as the first one. So.
Is that right, Ian? Because that is not what is all over the internet telling people to buy businesses. They're saying, hey, it's so much safer than if you go start a business yourself.
Well, that part is true, right? Like it's that whole, buying an existing business and then building off of that. But what Ash was saying, from a family business, yeah, you have entitled kids that are lazy. And this is another thing. Like, small business is really hard work. And when I was in my early 20s, when I first started doing this, all my friends, I wasn't, they were going and, playing golf during the weekdays and whatever they did. And it wasn't an option for me. Like that operation was always taking my time. And so people don't realize how difficult it is. So yes, Amanda, buying something that's existing and building on that is important. And Ash is also correct that second generation statistically doesn't do well.
I'll find the stats. I just did a solo podcast on why people need to stop listening to social media influencers. I want to guess it was like 50% of second gen businesses fail and only 5% of third gen businesses succeed. So by the third generation, it's done.
Yeah, I'd agree with you. You've got those big legacy businesses that have been in families forever. But yeah, for statistically speaking, because it's hard. And to your point, if you grew up, let's say your family has a well-performing business, you have entitlement. You have to earn your stripes within the business. When I first started, I went in there, we had terrible quality. Our clothing so we survived on cheap prices and everyone knew like, oh, that's the low cost place to go. I started, you had to earn respect. And I went in there and started pressing clothing. I was horrible at pressing pants. And, as I went through that business, I learned I can do everything in this entire operation. And so that was, it's different in every style of business, but that helped me tremendously in the service business, being able to go in there and, not just tell somebody how to do it. Like we would have staff that if they didn't think it was their job to clean a toilet, like that's not my job. I'd get on my hands and knees and I'd clean the toilet in front of them and say, okay, here's how we're doing this. This is how we operate here. You could tell really quick, right? Like if they didn't want to work there anymore, they're out. And so it's hard. There's no way to sugarcoat it. It was not a glamorous role.
So and you're going to be successful in anything you do. I want to hear like how you have transitioned into real estate and how you've set up your business. But Ash, hit us with the stat.
Yes. So 30% of second gen businesses survive. So 70% failure rate. Third generation, only 12 to 13% make it.
Is that when they're passed down to a child or purchased?
No, it's family passed down or sold.
That makes more sense.
Yeah, I couldn't find stats on actual purchases, but in terms of family businesses passed down or, for free or for money, huge failure rate.
That makes sense because they're probably just going to wind them down like the first gen would have. They just passed it along. I think that makes more sense than purchasing. I'd love to hear a stat on that.
Well, also, if a business is handed down to you, what do you have to lose? Whereas if someone's coming in as a third party, there's a bank note. They've maybe put a personal guarantee, their house on the line, so I think it's a lot about internally what you have to lose that drives those others to do it. And they have the wherewithal to go purchase that business and do due diligence and underwriting. Like, I'll be frank, when I bought this business, I knew that it was a good opportunity. It was longstanding, but I can tell you going through when I exited, the gentleman that bought my business, he was an M&A before, and he was so far advanced compared to what I knew. Like hey, we're going to have this third party auditor come in and I need X, Y, and Z report by tomorrow so they can, audit you. And I'm like, yeah, of course, I'll get that done. And then I'm back at home at night, on the like, what in the hell is this report? Because we were a keep it simple business. And so there is so much more that goes into it today where, to wrap this into your question about family investing or somebody buying from the outside, the people that buy from the outside do that. I didn't perform third-party due diligence on my dad's business because I was already running it for, 5 years before buying it. But a big difference for what people
That is a great point. Now, you had some active real estate investments. Then you started investing passively. And what was the next step beyond that?
So I want to rewind just a sec because the hardest thing for me, like getting into that transition of, okay, am I an active investor or am I passive? I told you about my business and how I like to be in the center of everything. I was doing that with my own properties. And then all of a sudden you get to these passive investments and it's like, oh, let me give you $100,000 or whatever you want to pitch in for that deal. And you take care of it. And that was scary, right? So I'll start with that. Like that was my biggest obstacle as an entrepreneur, knowing, okay, I trust myself, but do I trust somebody else? And I'll share a failure on that later. But the role, to your question, was, or what the transition looked like. I was used to moving at 1,000 miles an hour. And when I, quote, retired, right, it was a situation to where I didn't want to go. The entrepreneur in me wanted to go turn around and buy a business like 3 weeks later, maybe a couple of months. Like I wanted to take some time off. But then I had to remind myself, like, why did I do this? Why did I sell at 35 years old and get out of this business that was doing excellent? And so, and the reason it came down to the emotional aspect of it. So I got bored. And I knew that I could help other people. I knew that it was built around, integrity and someone who's honest and who was going to take care of something better than how you would take care of it yourself. So I was like, okay, if I'm going to be investing in these passive syndications, why too could I not be somebody as an advocate for, all these other service business owners or these high net worth professionals to go in and say, okay, I know that I can trust you, so therefore I'll trust this because my money's in it, their money's in it. Y'all know the drill. Much different than like somebody coming from the financial advisor world where it's like, here's a big menu of stuff where you're going to make what you make and I'm going to take my 1%. Whereas this was cool. It's like, oh, it's structured the other way around. Like we all have to win as a group. Investors got to win first in order for this whole operation to work. So I'm having fun with it. That led me to creating, building a network and finding what I love most in the industry. And again, all that was built out of what can personally help my financial situation and how can I also give that to others that may be in a similar position.
What do you think your role is today? Are you a syndicator, a capital raiser, fund of funds?
So I'm a syndicator. We operate as a fund to fund manager. My role for how I provide value to people is A, giving access to deals that they wouldn't have known about. And then B, being an extra layer of due diligence. So, if we're going to write you $1 million check, a handful of us, it's going to be something that's been, we double up on due diligence. We've vetted you. We've background checked you. I've been to the property. All of these layers that, okay, we're at least going to try to our best ability to eliminate the risk of something going wrong. And in kind of the position I put myself into, I'm not a risk taker because when I sold that business, I think it did well. And I think that I was in a position where I said, I'm not going to gamble anything that I just worked the last 15 years to build. Like I don't want to lose. And so my positioning is I'm much on like the low risk side. I'm not going to say it's always low return. They're good returns, but I'm not, somebody that's out there advocating deals that have these home run returns. At least, what a pro forma would say. Like we want this to be pretty steady Eddie investments that are just there and don't have as much volatility. So that's kind of what led me to private lending. So low risk private lending and then mobile home park investing. Those are the two lanes that I love the most.
So your syndications are all in mobile home parks?
There are mobile home parks. And then also I have a private lending debt fund. And so that was, again, what got me into this business was lending out. And I thought, okay, because I put money in money market accounts right away after selling the business. And at the time they were at 5.5%. So the question was, how can I increase that, but keep the risk minimal and not, take chances? And so I incrementally worked up to low risk deals that paid a higher yield. And then thought, well, let's make a business out of this because other people should be able to play in this arena as well.
Ian, I'm intrigued that you're saying debt fund when you and your other entrepreneur investors are looking for tax write-offs. Does your debt fund actually provide tax write-offs?
No, my debt fund does not provide tax write-offs. So that is a purely, an income play. And it's a monthly income play, which is nice. And it doesn't lock my funds in. So, our investors are able to put in, take out within a 90-day, obligation for us to return it. So I like both approaches. I think that, you're spot on. The tax write-off component comes from the depreciation of the mobile home parks. These are, assets that have the ability to bring a lot of equity upside to the investors, and to hopefully return their capital with a refinance in a couple of years. So I like having those two lanes, because there reaches a point to where someone may have, capital to invest, and they've already captured whatever write-off may be necessary to them. And I don't know if we have time to talk about this today, but another thing in the industry that I like educating people on is so much of what's out there in the passive investment or syndication world is tax write-offs, right? Like, you guys see this all the time, but I think a lot of them aren't marketed the way that they should be. I think that the everyday person, if you're a dentist and your spouse is a lawyer, then you're not going to write off, 100% of your ordinary income, your active income. They don't tell you that on the advertisements, right? It's like you get these huge tax benefits, and I can't tell you the number of conversations I've had where I'm like, hey, hold your horses. You're not going to be able to write it off all of it, but here's your path. And even if you can't get to real estate professional status, let me show you what the capability of this still brings. Like, let's put this money in a virtual piggy bank for you that you can use for your future passive gains, something that they maybe, might be foreign to them. And with this group of people that, like I told you, I like working with business owners. Our last deal in a mobile home park, obviously the laws change, right? The big beautiful bill changed it to 100% depreciation after that property had closed. And so it was like this big hoorah for everybody. But the majority of the people in that fund they were business owners, like veterinarian, cardiologist, a dentist was in there, restaurant owners. Like, these are people that are successful in their trade, but they're not real estate people. And so that's the group that I like to help the most, and kind of guide them into something that's like, hey, let me be the advocate for you.
Those people don't have real estate professional status, do they?
They do not.
Okay, so have you ever considered deals where they're able to sell their depreciation, so to speak?
At this point, we haven't. It hasn't been in the cards for the deals that I've worked on. But
Ian, I don't think a lot of people think about that, and I probably wouldn't have either. Except years and years ago, Joe Fairless was in one of my investments, and I told him, hey, we also give depreciation to a cost tag. He's like, I don't need depreciation. I'm like, wait a minute. Can we have it? He's like, yeah, I don't need it. I'm like, oh my God. So then the wheels started turning. And, now when people invest with retirement funds, there's a checkbox on the PPM. Hey, is it okay if someone else takes your depreciation? It's a yes or no. But when you have people like that don't need their depreciation, can you go back to the syndicator and be like, listen, my guy or my girl only wants the returns and the bare minimum of depreciation to offset their passive income? Can you benefit by giving somebody else or keeping back the depreciation and maybe throwing them, another point on the deal? You think that would work?
That's so I'll say this. I have not done that before, but from the way you're describing it, yes, I think that would be an attractive option. Let me ask you, if how many people on their retirement accounts are then checking that box to say, I don't need it?
Believe it or not, on our last deal, all of them checked, yes, you can give it away, whatever the question, however it was phrased. There was one person that didn't check, so we explained it to them. And they're like, oh yeah, have at it.
Wow.
But, I don't care as much about income as I do depreciation. So I don't know. I would think about that, because it's a waste if somebody's getting passive losses and they can't do anything with.
Yeah.
I would try to use that to your advantage.
Yeah. I like that recommendation. And I'd be curious, this was all of their available depreciation that they said, take it all?
Yes, because in a retirement account, they're not getting taxed on the gains anyway.
Yeah. Okay. So only if you're a retirement account participant.
Correct.
I
Correct.
got you.
Or, you find another whale that doesn't need depreciation. They're probably like unicorns. There's not many of them out there. Maybe see if you could take theirs.
Yeah. I like that approach. It's good advice.
And there's some pitfalls in the asset classes you mentioned. How did you become an expert in mobile home parks in order to kind of shepherd due diligence on behalf of your passive investors?
And be careful. Amanda's been a mobile home park investor for many years. She's setting you up here.
Right.
She's setting you up.
Yeah. So the reason I'll say this, number one, I picked that course. It was what I was most heavily invested in when I first became an LP. So before I made that transition, I was most excited about the space. There are pitfalls in it. The opportunity that I liked within that was more of the low operational expense and the ability to, what it means when you're buying a property and the ability to fill up empty lots and what that can create from an equity position. Now, the thing that I mentioned earlier as like in regards to all of these syndications is at the end of the day, and you know this, Amanda, and if you're not running the deal yourself, there is always inherently some sort of risk that will come with that. And so the most difficult challenge, and I'm still trying to find the best way, and I think everybody in the industry is, how do you get to the point to where you've done everything humanly possible to say, this is going to be safe for my money and my investors' money. So, I mentioned earlier, I'll take their underwriting and I'll underwrite that. It's difficult sometimes to get that into a model of your own, especially if it's a robust, you guys have seen these sheets to where they're 15 pages long with sensitivity analysis and different cap rates that they're projecting. You can generally, point out, where are they getting a little bit greedy on this? Can they raise rent 6% in the first year? Can they do, and these are all asset classes.
6%, Ian, give us something challenging.
Well, yeah, some areas you can't, if someone told me right now, if they were, bringing an Austin multifamily deal, in my desk, like, well, next year we're going to be up 6%. Look, I took rent concessions. Austin just came out, it was like one of the largest in the country for rent concessions. I'm doing it on my rentals now outside the syndication world, right? They're getting smart where they're saying, hey, the market's softer than it was. And I know that you normally like to increase rent, but what about taking a $500 reduction each month? And it's like, oh, they're clever because there's
okay. Now you're talking about multifamily, Ian. You switched on us. Yeah, go down in the rents on that class. Mobile home parks, man. No, you're up in those rents.
Let's get back to mobile home parks. But those are, I like the class the most. I think there's a lot of noise out there for different classes. And for me, what I've seen is there's, we had a run at self-storage. There was a run, multifamily, like every asset has its pitfalls. I just felt most protected by this particular one from an affordability issue. Just being able to say, okay, if we can rent out dirt in a town that has apartment rents that may be $700 a month for the same, can we offer a good product and a good place to live for these people at a lower rate?
So did I just hear right? You have in your fund of funds, multifamily, mobile home parks, and self-storage, those three? I'm
not in multifamily apartments in my investments. So it's self-storage. Yes. Well, and I'll say this, it's an awful thing that happened from 22 and 23 and what's happening to the industry. But I think that maybe it repositions the way people think about how are they going to invest next, and whether that's somebody from, and not necessarily on like the GP side for someone that if that's their bread and butter, like I don't think you give up on an asset class. Things are just different today, and there's much more safeguards in them. So
across the various asset classes, I assume you have a lot of operators pitching you deals, telling you how great their offering is. What are some things that are immediately no's, hard stops?
If this for my business or as a personal investor?
For your business, if you're going to put it in your fund of funds.
If I see crazy equity multiples or return projections, red flags go up. If I see an area where I don't think a lot of growth is coming, I might shut that down. And then now, if we're getting into these bigger projects, which most of these syndications then have a lot more units that are a part of it, I want to be able to see a little bit of, upside to these, to where if they're, cash flow will be squeezed if they're at 95% occupancy on day one, right? You've got a well-oiled mobile home park or manufactured housing community at that point. So I want to see something that's, could be in the 70s or low 80s, where there's a little bit of meat on the bone to where we can have good cash flow and get in at a good rate. But the biggest thing, and you guys see this in this industry, you get pitch deals all the time, and you get this big blur of like IRR and what our cash on cash is going to be. And y'all know, like, a lot of it's smoke. Like, who's this operator? Can I trust that person? Because at the end of the day, I forget which one you said it earlier. You're like, no, Ash, it was you. You're like, I'm not really focused on the income. I want the depreciation. Like, that's what's most important to me. And there are a lot of people that are like that. They're like, if you told someone it's a 7 or 8% return or a 6% return, and they're like, well, hold on, my focus is depreciation. I want to offset against some income. Does this help my scenario? I think that at that point, they're willing to give up a pro forma, percentage point or two or whatever to go with somebody that they trust, that they know has a good track record, and that they can park, comfortably their funds with to help them with what they really need, which in that case is depreciation.
Ian, you mentioned track record. How big of a factor is that in the deals you invest in?
I think it plays a significant, it's a huge thing. It's a huge part. So I'll get a lot of people locally, for example, that are like, hey, I've got this deal going, do you want to help raise for it? I just had a friend that took me to lunch the other day. They're doing land entitlement and land subdivisions. Great, like fun as an LP, right? But for my business, I'm looking for someone that I can see has multiple, 10, 20, 30 parks under their belt. I have to like that person too. So I want to spend some time with them. I'm not in this for, like, you guys know, it's all about partnerships. I don't want somebody who's arrogant. I want someone who's available on the phone, especially if there's going to be an effort to give to them as a collective unit, right? Like, we need to work in as a partnership. And so I'm looking for good people. Then you get online and you search the dark web for scam, Ponzi, all the other stuff, which you should. Every LP investor should. Every fund manager that is going to partner up with someone should do the same. Like, they should be upfront and be like, you're getting background checked. What you got on your record? What are we going to find? That's the kind of stuff that's important to me.
You also mentioned equity multiple, and I think that's great advice. Even if you have a deal that's absolutely bonkers, dumb it down when you're presenting it. Human nature is just that. I saw a thing on LinkedIn where a guy said 25% cash on cash. Next, like, didn't even bother, right?
Yeah.
Shame on me. I probably should have dove into it, but it's just, we're so jaded that we assume it's a scam. So really, great advice. Dumb it down if the numbers are through the roof. How important is it that the GPs put their own money into the deal and not just the fee money? Because we know that game. Yeah, we're investing alongside of you. We're rolling it in. Yeah. Do you care about how much of their actual money out of their bank account goes into the deal?
I do. Depends on what capacity they're in. I will say that if they're acquiring the deal and they have the property management group and they have the track record, I want them to have skin in the game, but it may not be as much as if I'm going into a syndication and I'm an LP and I want to invest with somebody. That question always comes up. How much are you putting into it? Not yes or no are you putting into it, but how much? Because to me, that's important. Like, if I'm raising capital from somebody and they're going to put $400,000 into an investment, and I'm like, well, I'm in for 25. It's like, okay, what's the person in it for? Is it fees? Is it just getting another deal done? So I'm fortunate to be able to have runway with where every investment I look at. It's not for the investors first. It's for me first. Like, do I like this? Can I go tell my wife that I'm excited about this boring ass low risk investment? Which she's always like, quit using the word boring. It's so overused in your industry. I'm like, okay. So, but yeah, I want to be comfortable with it first. I am putting my own money in every deal, and it's, whether that's 50, 100, 200, like what will it be? obviously you have to give yourself the ability to say, how many of those can you do per year, and what's your runway look like? But yeah, I think I hear a lot of people that say it's their selling point, and then now I've heard chatter to where it's like it's not so important to do in each deal, especially if you're actively engaged with it. To me, it's just like another security blanket for an investor, because I use that example about financial advisors earlier. It's like, pick from this big, okay, here's our portfolio, here's what you should do. And it's like, if you've got somebody that's in there and, they're on their W-2 and they're just kind of pointing their fingers, but they're not in it themselves, it's just different. Like, it's just something about it. They're like, hey, I don't want to lose my own money first. I definitely don't want to lose yours. So let's go at this a little bit harder than, clicking a button for something online that someone takes a commission for.
Does that mean you invest in all of the deals that you do fund of funds on?
I do. Yeah.
Okay.
I'm the first
Good.
one in. Yeah.
You mentioned it's absolutely awful what happened to multifamily from 22 till now. I don't think it's awful.
He says with a smile, by the way.
Okay. Well, I think it was overbought. It became too easy, low barriers to entry. I literally met people that went to a boot camp or a course or a mastermind and started raising millions of dollars and doing their own multifamily syndications. It never should have gotten that easy. So there was stupid money going into multifamily, which brought down cap rates, increased the competition, and it was just a house of cards that came down.
Yeah.
Right. And the story you hear is, oh, we never expected interest rates to go up. We did. Like, we didn't know when it was going to happen. We all knew it. With multifamily, there's been a lot of fund of funds people that fueled those deals, because in Amanda's world, my world, our deals are typically well under $10 million. It's not uncommon to have $50, $60 million apartment complexes. So they needed fund of funds people. And that drew a massive crowd of people getting into the fund of funds business. And this might have been before you, but that business was dirty back in the day. They would demand 30% of the GP be carved out for capital raising. So these capital raisers would come in and say, look, if I come in, I want my proportionate share of the GP. And one, that's illegal. And I think a lot of them have gotten away from that now. But what kind of shady shit do you see going on with other capital raisers?
My biggest issue is that, and I know this out of like where I'm at with my capital raises. In the last mobile home, community that we did, it was right outside of Nashville. It was like 150 units. And that one, the raise went fine. It, filled up quickly. And then my wife was like, how much are you going to get paid from that? I'm like, well, today, not much, next to nothing. Down the line, it will benefit everybody. And I thought about that for somebody getting into the business, and it's unique to everyone's position. But as a capital raiser, I think that it gets shadier when that becomes their sole source of income. Acquisition fees, let's broker this and push this. I think it gets a little dangerous, because at the end of the day, people are self-serving. And if they have a number in their head they want to hit, they might, close their eyes and say, I need another raise. I need to make an acquisition fee. So that's, I think, going to be the most difficult thing. Because I had that conversation with my wife. I was like, if our situation was different and like I needed a paycheck, then this business would be very difficult, because I might get paid in 5 or 8, 10 years down the road, so great when it, if we can fast forward 5 years, but like, what about today? And I think that's the danger zone, to you said that Ash, everyone was like diving in. It seems cool. Money was flowing during that period too. You talked about all the people that got in. It's just, there was a lot of income just sitting right in people's accounts, and they were just itching to disperse it. And so I think it was like prime opportunity for capital raisers to come in. And I've learned a lot along the way, from transitioning from an LP to now in my role, in different projects. It's like, it's really difficult. It becomes kind of like the wild, wild west. And how do you find, how do these individuals vet, someone that's going to be trustworthy? And that's, I think, the hardest thing. It's why this is, you guys know it's a relationship game. This is slow. Don't expect to make it overnight, because I think you're exposing yourself to too much risk if you're trying to say, I'm growing from 0 to 100 million by the end of next year. That's what I'm doing. Like, I think that person is dangerous.
many of them do not vet the operator. I've been in some of these Zooms. I've talked to a lot of these capital raisers. They don't ask questions about the background. They've approached me wanting to bring their investor money to my deals, and literally all they care about is how much can they get paid. Yeah. They don't ask me questions about me, the deal, the background. They just want to know high level, the simple metrics, IRR, equity multiple, all the nonsense, but they don't ever dive in, which has really jaded me on capital raisers. So you're significantly different. I think you need to do what I do and start calling out the bad capital raisers. Or if you want to take the high road, start teaching people how to vet capital raisers, right? So just like these syndicators do, hey, here's what makes a good LP investment. You should really let people know what makes a good capital raiser, because there's so many bad ones out there.
Add in any risk that you're taking. So many of these operators that are raising from fund to funds, they are saying, hey, get in. There's no risk to you until all of your passive investors sign up. Just come on board. We'll do everything. We have your slide deck. We'll tell you what to say. You just sign everybody up and let's go. That's not what you're doing. Yeah. So make sure you're letting everybody know about the risk that you're taking and the lack of the upfront fee you're taking, because those are for sure distinguishing.
Yeah. And there's a lot of expenses too that happen, when somebody's vetting these deals. Like, I don't know, before I'm saying yes to something, I'm going to be on that property, walking it with the sponsor. Matter of fact, I told the last guy in our it was in Clarksville, but I said the mobile home park right outside of Nashville. It's like, I have an expectation for our performance to be X, and just teasing him. I'm like, if it doesn't, or if we dip below where I think it needs to go, like, I'm flying to your home and then we're getting on a plane and we're going to go work on that park until it's like, it's not an option. So when somebody, because this is a big mistake, right? So, you hear all this stuff on the internet about passive investments. Let's just push real estate aside for a second, e-commerce, like things that affiliate links online. For everything that's passive for one person, it's very, very active on the other. And so I want that person that's willing to work. That's kind of like the cost that the LP or the passive investor is paying for. They're willing to take less of a profit share so that the person working the deal can get their cut. Now, it's the passive investor needs to know that on the front end, it should be very active. Like, there is real estate's a full-time job. That's why these people are doing syndications. That's why people are excited about getting involved, because they don't want to be a landlord. So there's so much that goes into it. To your point, like educating people, I think it's a challenge. And I think that the more just kind of down to earth and rooted you can be, the better results you'll have. Because you never know, in this relationship world, something might happen with an investor 2 years later. It just takes time.
Speaking of relationships, Ian, earlier you mentioned you had a failure from trusting someone perhaps you shouldn't have. Can you share?
Yeah, I've had a failure as an LP before, getting into the syndication world and not knowing any better. Trustworthy, maybe a bad character read on my part, but it seemed very trustworthy. And, you guys hear about this too often, to where it's like, where's the money, right? And so I have had a failure as a personal investor outside, my funds that I run, and it's taught me a lot. And to your point of like, who do you trust? I think that Ash, you talked about people just signing up, being like, hey, can you carve out a certain percentage for me, and let's get this done so we can make some money. I think that's the wrong approach for a lot. It should be, I don't want to have 50 friends in the business that are operators. Like, if you're a stud at running, your multifamily, or like Amanda, like this, if you're boots on the ground, or whoever that I can say, she's my girl, that's what I want. 3, 4 friends. There's enough deal flow in there to where you're not getting ahead of yourself and trying to be the next person. Cause I think eventually the more that people try to, if you got 20 deals, no, 20 is an exaggeration. Nobody has 20 deals, but if someone's raising for 4, 5, 6, 7 deals at a time, it's like, how, you guys know the effort that goes into these projects if you're giving it what it deserves. So,
Ian, I'm impressed. You actually walk every property. I've never heard of a capital raiser doing that.
The debt fund is difficult. There's 400 something homes in there. We're just playing bank at that point, right? But the mobile home parks, yeah, I want to be on the property. I have even done it. I'm in rescue capital positions as an LP, and I've even done it there. I've gone to the apartment complex and acted like I was a resident. And I sent a report, whether they wanted it or not. The group got a report back on like, hey, your doors were locked. There was no signage. The lamps are all broken outside the doors. Like, I don't know. I just think it's important because this business is not overcomplicated. All of it, though, it takes work. It's not just, sitting back and getting paychecks.
Yeah. And everything looks rosy on the OMs.
Yeah. Yeah.
It's like some of these models on Instagram.
Yeah.
Okay. So how do you get paid?
So
on the fund of fund side.
On the front side?
Not the front side. How do you get paid on the fund of funds side?
Yeah, that's a great question. So up front, what I did on our last deal was we will negotiate terms with a sponsor or an operator that is perhaps enhanced because we're bringing more. Think of it like as a big LP position and we're bringing more. So there may be more profit share there. We then want to pass that along to our investors to where they're getting equal or better returns, because what's our worth if they're getting less than what they could go direct? I think it's we want this to be a holistic win-win situation for everybody. So generally speaking, if there's a difference in there between perhaps like if someone's getting past 85% and then you're passing along 80% or 75%, whatever you've decided on, then, it comes from fund management fees along the way, like really minimal stuff. And the way that we structured the last one was the payment really comes on the tail end. Along the way, again, it's not going to move the needle from an income perspective for whether that's right or wrong, right? Like I wanted it to be juicy for the investor, which I'm one too, right? Like I play both roles in these things. I'm an LP also going into it. So that's generally how I structure it. Like it's back end.
Are you part of the GP, or what is your structure in there? Where do you fit
last
in?
one? So some of the structures are different. I'm a co-GP on my debt fund. But so I have my own debt fund that we place into another vehicle. So that one's run a little bit differently. And on the last mobile home park deal, we came in as an SPV. We were one large limited partner. And so we're not acting as a GP on that. We're kind of like everybody else, but with enhanced terms just because we had a different share class.
And how do you get compensated for the extra due diligence and everything you're doing, finding the opportunity compared to the passive investors that come along with you?
We did on this last one, like a 1%, I think it was 1 or 1.5% due diligence fee that was in there on the front end. So for the amount carved out on our end, it was, sufficient enough for like flight times, hours, conferences to really make sure that the deal was vetted properly. Now, that obviously all those expenses are paid for first, before you fundraise. And so that's one of those expenses that just in the business, if you find that the deal's not for you, or there's something in your gut that's not, telling you it's right. It's just you just eat the expense. That's a business expense for me that's lost, and will not work with that person again.
And then your compensation on the back end, how is that split out from your LPs?
So compensation on the back end is, again, it comes down to the profit share split between what is given to the investors that get into a deal and then what we are getting cohesively as a unit. So I used that percentage spread earlier of like, if it's, if we're receiving 80% and operator keeps 20, and then we're saying, okay, of the 80% that we receive, we're going to give the investor 85% of that. If you multiply 80% of what's being received times 85% of that you receive, it's like 68, 70%, right? Somewhere right in there. That is, so an investor on the back end is getting, let's say 70%, 68% in that scenario. Now we need to make sure that are they getting better terms going direct? Because obviously if they are, I don't think it's beneficial, and it's not responsible for me to sell this deal if they could go and get a better deal elsewhere. So if it's a good deal that I like, I'm willing to take less and work it on the back end. And then again, that's just through equity appreciation, whatever we end up selling the thing at down the road.
So you're taking
Ash,
about a
smiling.
1%.
What are you thinking on this?
Well, you're taking 1% as a due diligence up front, and then it's just a percentage of what the total LP would get set aside for you for putting it together. Is that right?
I think
to
we
simplify
had a
it?
fund management fee in there that was like very small. I think that was paying like our software for our platform and stuff that was on there. It's nothing to write home about. I can tell you that. It's very much a delayed gratification on that one.
All right, Ash, you had something very exciting.
Well, no, I hope you know that you're a bit of an outlier because no one else that I've ever spoken with is cognizant in making sure that you're actually providing them value and just the returns are above and beyond what they can get direct. Do you know how many times I've asked these capital raisers? It's like, hey man, why would they invest with you when you're taking some off the top? And I get it. At times they negotiate better terms, but even then I say, they can get a better deal if they just go direct. Yeah, but I do all the due diligence. Bro, they don't even go to the property like you do.
Yeah.
Right? You're earning your 1%. What are these guys doing? They're literally just turning paper and creating a story and a persona, letting these investors that are not savvy, they don't have the time to research what we know, and they're taking their money, promising a whole bunch, of smoke and mirrors.
Yeah.
Right. Well, so good for you, man. I'm impressed with your integrity. That
came out first when I was sitting down with, other syndicators that are in my city. And I remember not knowing the industry well. And I sat down with this gentleman and we were talking about it. And he was like, I think my head the whole time as an investor was like, why would I go with this guy? Because he's really nice and all, but what if I could get a better deal? And so I knew that the structure needed to be like that because again, someone could do an extra layer of due diligence, but at the end of the day, it's the same deal. So if you're willing to, invest in something that's the same deal from whichever party, right? At the head of the ship is still the same person. I don't want to take a cut as an investor, I don't want to take a hit on the return because there's a middleman. I think it's, the incentive is and should trickle down from the operator themselves. Like they should be willing and wanting, because if you're going to say, hey, bring $1 million to the deal. Okay. Well, if you're getting $50,000 or $100,000 checks, it's tough. You need 10 or 20 people that you have to go fundraise from. And so like it should be mutually beneficial for the sponsor and the capital raiser and the investor at the bottom, at the bottom. Everyone wins. Otherwise, I think the deal doesn't make sense.
I hope you share a lot of this on social media because a lot of people who invest with funds of funds people probably don't know this, that there's better options out there. So I would just call these people out, man. Not by name, but call out the industry and the bad practices, right?
Got to work on my social media presence.
And if you get drunk one night,
biggest obstacle for me in this whole industry. I don't think I had ever a post before getting into this space in my life.
All right, if you get drunk one night, just start getting on LinkedIn and calling them out by name. Hey, so I got a question for you. I know Amanda said, how did you ever learn to underwrite mobile home parks?
Yeah.
She's going to jump my ass on this one, but mobile home parks have to be easy to underwrite compared to all the things you underwrite in your debt fund. How do you do that? All different asset classes, right, in your debt fund?
Yeah, the debt fund, and again, we talk about leveraging experience. That group that runs the day-to-day on that is, there's a gal that's in the head of it. They're ex-flippers and they're just like great people. That got me into the business. And so the underwriting on that is much, much different because they're looking at first position liens, 65% LTV, there's 450 homes in that portfolio. So like I, as an investor getting into it, was thinking, all right, if you do $100,000 into this fund, it pays me 8%. And at that point, it's going into 400 something homes. Like from the safety of, you hear, well, flipping houses is risky. Yes, it is. If you are doing one or two and your buddy watched Instagram video and like thought it was easy. To your question on the mobile home park side, what I had was when I first started this, I had, back in the day, my underwriting for, it's not the same. Like you can't compare underwriting to a single family home or like a little commercial triple net property to the mobile home park space. So I just dove pretty heavily into finding several models that made sense for me online and then tried to build my own model, taking the best pieces or making the best thing that I could. Then what I'm doing is taking the operator's underwriting that is given to us and then poking holes in it, multiple meetings, sitting down. Like, again, I talked about being aggressive, and maybe my 6% rent increase thing that I brought up earlier wasn't a good, wasn't a good argument for what would really stand out, but I'm just looking for things that don't make sense. Because again, this business and real estate in general, like, yes, there's hard work that goes into it, but the mathematics of it are pretty simple, is at least the way that I view it. And I think that if there's anything that you're scratching your head about in underwriting, like how does it get from this to this, red flag it. That's a problem. And let's see exactly what's happening. Like if you can increase rents, but decrease all of your expenses, cool. That's great. Like we want that, but how?
I love that you have a team doing helping you with the private lending side. So you did learn something from the dry cleaners, start building teams, putting systems in place. Go ahead.
No, that was just a regret from earlier in life. I think that back in the day, I wanted, and this was before even getting into passive investing, I only wanted to own the property myself. I only wanted stuff. And that's just, I think, being young and not knowing better. And so what I've learned is I wish I would have partnered up a lot sooner back in the day. I think I missed out on a lot of opportunity. I think it holds people accountable if they find the right partners. And so that was my big learning lesson. And to your point, yes, like I could try to do something locally here to where I'm lending out on, individual homes, but my, comfort and the season of life where I'm at, like I have 3 young children. I have 5, 2, and then a newborn. I don't want to be out there grinding all day long. And so this business really complements the lifestyle that I'm looking for, at this phase of my life as well.
I know you're newer to the fund to fund side. Have you built systems and teams for that side of the business? So
the best thing that I've learned in my journey with the fund to fund is, number one, finding the right operator that I want to, the person that is a good advocate for my own money and someone that I want to work with. I will then, again, my systems, a lot of them were still built around me. I think that it's foolish sometimes to jump into leaning on other people, because I don't believe that you can learn that the stuff that you need. If I was to, for example, go and just have somebody underwrite it for me and tell me, hey, is this good or not? Because then I don't think you truly grasp what you're looking at. So it was just a lot of reps, like just finding, and I do this with real estate. I do it with businesses too. I love that intersection of like business, real estate, and then that little sliver in between, because there is a lot of overlap. And so I think just more reps on that has helped me. And then with my help and teams, I have virtual assistants that will help me with stuff. Not underwriting though. I don't, that's just admin stuff, nothing beyond that.
Ian, your first hire should be a social media helper. And best ever listeners, if you watch this on YouTube, Ian's a young, good-looking guy, always smiling. I need that personality to come through on social media, man. People would fall in love with you.
I need some help. It's very embarrassing getting on there and talking into my phone. And so, come find me after this show and help me out.
Ian, where do the best evers reach out to you?
So after the show, I want to give a link to you guys for your listeners where they can get, we talk about vetting syndicators or these operators. So I put together a really nice cheat sheet that I included in the show notes. So number one, they should get that. And when they do, it gives them like an easy step-by-step on what they need to be looking for before they invest into something. And secondly, it puts them into my ecosystem, into our network where we'll give educational tips, private deals, etc. I'm on LinkedIn, probably more active on LinkedIn than the other platforms. And then also on Instagram. That's a new thing, but we're learning. It's Ian_invest, plural. So
can you also create a cheat sheet on how to vet fund to funds people? Because 90% of them will be out.
I need to make another layer, to that one and help out. And then my website, it's runsteadyinvestments.com is where you can find all the information there as well.
Ian, thanks for joining us today. Appreciate
Yeah.
hearing about your story and us finding out ways that you're different from a lot of fund of funds managers out there. So great job.
I didn't know that, so thank you. And I enjoyed talking with you all today. It was a good conversation.
Hey, good. Ash gave you a ton of talking points going forward.
Yeah, thanks, y'all.
Best ever listeners, thanks for joining in today. If you enjoyed this episode, make sure you leave us a 5-star review. Don't forget to subscribe, follow, and of course, have a best ever day.